Hey investors, I hope you're doing well. I'm sure many of you, just like me, remember that epic Western film, The Good, the Bad and the Ugly. It's an unforgettable story of pursuit, downfall and riches. It really gives me the same feeling that I have about the current state of the REIT sector. In this video though, we'll be zooming a bit further into Realty Income, perhaps one of the most well-known REITs. I'm going to share with you what is currently happening with Realty Income and why it also has its fair share of good, bad and ugly things about it. Like most other REITs, Realty Income has underperformed the broader market by a wide margin over the last several years. And real estate has been struggling this year as well, which is being reflected into the performance of Realty Income. The stock is down almost 19% year to date, while the S&P is up over 14%. Realty Income is widely regarded as one of the highest quality names in the net lease REIT sector, but its high quality has not made it escape the same headwinds caused by higher interest rates. The company recently made a hefty $950 million investment into the Las Vegas Bellagio casino property, which appears to have been received positively by many investors. Sounds good, right? Not so fast. The math reveals that the total 7.7% equity yield isn't as impressive as it seems. The Bellagio property was initially acquired by Blackstone in 2019 for $4.25 billion. Realty Income's investment occurred at a $5.1 billion valuation based on the same 5.2% cap rate that Blackstone acquired it for. Taking into account debt, preferred dividends and future refinancing, the cash flow available for common equity is lower, which results in a yield that could be as low as 4.7%. In addition to this, the investment is actually something that personally has me worried. They are moving away from their core operations, now investing in gambling and leisure properties as well. Peter Lynch would call this diversification. Even though for now this is a relatively small investment, this strategy is not a good sign in my eyes, and I'm becoming more concerned that management is now employing a growth at any cost strategy. Having discussed refinancing rates, it's worth noting that the majority of Realty Income's debt is locked at a fixed rate. Approximately 8% of their debt is subject to floating rates. However, the current concern lies in the substantial amount of debt that Realty Income has maturing in the near future, which may need refinancing at potentially higher rates. This poses a significant challenge not only for Realty Income, but also for the broader real estate sector. Most of the things I just mentioned are not new and have most likely already been priced in. Now the question is if people are overestimating the concerns. For example, Realty Income is trading at a 14.3 times forward price to AFFO ratio, lower than its 5-year average of 19.3 times. The dividend yield also makes the investment attractive currently, with the yield sitting at 5.58%, which is trailing higher than it was in 2017 if we ignore the pandemic crash. We should also not forget that Realty Income houses some of the strongest companies in the United States, like Home Depot, FedEx and Walmart. Most of these companies provide people with essential needs, making them more recession-proof than a lot of other companies out there. Such tenants provide Realty Income with a safer and reliable income stream. These factors are something we'll dive into a bit more in the next segment of today's video, and after that we'll be performing a valuation at the end of the video, and for this we'll be using a margin of safety. On this channel, we determine our margin of safety by looking at the key ratios, financial health and growth of the company. We'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety will then be able to increase or decrease based on the metrics that we'll be looking at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from a margin of safety. And when we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. After that, we'll be performing some valuation using models like AFFO multiples and discounted dividend to determine the intrinsic value of the company, giving us a fair value of the business. In conclusion, we will be combining all steps and determine the fair market value of Realty Income based on multiple factors of the business. The first metric that we use is EBIT growth. For Realty Income, this is looking very solid, with the 2013 EBIT being $378 million, going all the way to $1.3 billion in 2022, which is an average EBIT growth of over 15%. This awards them with a 5% deduction from the margin of safety. As for the margin growth, it has gone down over the years. The margin has decreased, going from 50% in 2013 to under 40% in 2022. This is an average margin decline of 2.5%, which, looking at our scale, adds 5% to our margin of safety. Next up we have the dividend growth. As many of you might know, Realty Income is one of the few REITs that is part of the Dividend Aristocrats list. They have increased their dividends for 26 consecutive years, and over the past 10 years their dividend payments have gone from $2.92 a share in 2014 to $4.08 a share in 2023. This gives them an average growth rate in the dividends of 3.5%, which indicates no change in the margin of safety. The next metric we are looking at is the debt to EBITDA. Like most REITs, Realty Income is very heavy on debt. To determine the debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the number of years of EBITDA it takes for the company to pay off all of their debt. And for Realty Income, this ratio is sitting at over 5 years. In this case, a debt to EBITDA of 550%. This adds 5% to our margin of safety. The next metric that we'll be using is the occupancy rate. Occupancy rate is a key metric used in real estate analysis to measure the percentage of occupied rental units or properties within a specific portfolio. The occupancy rate for Realty Income is above 99%, which is a very solid number. This means that only around 1% of their property is currently vacant and not generating any rent, awarding them with a deduction of 5% in the margin of safety. And the last metric we'll be using is the rent reversion rate. Rent reversion refers to the potential for rental rates to change when leases are renewed or new tenants are acquired for a property. The rent reversion for Realty Income is looking pretty decent. As we can see, their rental revenue is going up in line with their gross property. This indicates that they are generating slightly more rental revenue from their properties. There was a massive increase in gross property in 2021, while they didn't increase their rental revenue by as much, but this stabilized in 2022, causing the rent reversion rate to stand at 1%, meaning that this metric won't change our margin of safety. Now that we have gone through the company's financials, we're going to be performing valuations to see how attractively priced Realty Income is currently. The first valuation model we'll be looking at is the price to FFO mean reversion. Price to FFO, or funds from operations mean reversion, is a valuation model used to assess the attractiveness of a REIT's stock price based on its historical FFO multiples. FFO is a key metric for REITs, as it represents the cash flow generated from their core operations. In this model, we compare the current price to FFO ratio to its historical average. If the current ratio deviates significantly from the historical mean, it suggests that the stock may be undervalued or overvalued and is expected to revert to its mean over time. We've imported the share price together with the FFO per share of the past 7 years. With this, we can calculate the average price to FFO of this time period, which is sitting at 19.32. If we do the same with the trailing 12-month data, we get the trailing 12-month price to FFO of 13.56, which is significantly lower, giving us a fair value out of this model of $78.65, which is an amazing 42.5% upside. The second valuation model that we'll be looking at is the dividend discount model. The dividend discount model is a valuation model that calculates the present value of expected future dividends to determine the fair value of a stock. It assumes that the intrinsic value of a REIT is the sum of all its expected future dividend payments, discounted back to the present using a discount rate that reflects the risk associated with the investment. The model is based on the premise that investors value the income generated by the REIT's dividends and that future dividends are a crucial factor in determining the stock's worth. In this model, we have imported the dividend payouts of the past 5 years. With this, the average dividend growth rate is sitting at 3.04%, and I'm projecting a growth rate in all of their future dividends of the same 3%. And we will also be using a discount rate of 8.5%, giving us a fair value of $76.41 out of this model. This is an upside of over 38%. And the last model that we'll be using is the AFFO multiples valuation. Adjusted funds from operations, or AFFO, is a measure that reflects the REIT's FFO adjusted for capital expenditures and other non-recurring items necessary to maintain a property portfolio. AFFO is considered to be a more accurate representation of cash available for distribution to shareholders. The AFFO multiple valuation is similar to price to FFO, but it uses the AFFO metric instead. By comparing the current market price to the AFFO, we can assess the relative value of the REIT compared to its peers. In this case, we have imported the price to AFFO ratio of similar companies to Realty Income. On average, this ratio is sitting at 11.47. This is quite a bit higher than the price to AFFO of Realty Income, which is sitting at 13.78. This gives us a fair value of this model of $69.85, which is an upside of almost 27%. Let's go look at the final overview of a valuation next. Coming to the final overview of a valuation, taking the fair values of the price to FFO, AFFO multiples, and discounted dividend models, we get an average price per share of $74.97. Including our margin of safety that we have determined earlier into this video, we get a fair value of $59.98. And then with the current price of $55.19, we're left with an upside of almost 9%. Keep in mind that with the current economic environment, REITs have a harder time operating since by nature they are always heavier on debt. With debt maturing, they are forced to lock in their debt at the current higher rates, and for Realty Income this is no different. On the flip side, most of these fears seem to have already been priced in. The REIT sector will probably be in a fearful state for a longer period, but this does give you the time to find great opportunities for the long run. And by the way, if you want to get access to the valuation models used in this video and much more spreadsheets, you can check in the description for my Patreon link. This would support me a lot. And that wraps it up for this video. I really hope you enjoyed this deep dive into Realty Income. If you don't want to miss any of the other dividend related videos we make, be sure to hit the subscribe button, and thank you so much for watching. See you next time.